A very good morning, students. So in the last class, we have completed our discussion regarding chapter number 3, income from house property. Now time for the chapter number 4, capital gains. Capital gains. So from examination point of view, most important chapter. If you remember, sir, in our beginning classes, we have seen the list of important chapters from the subject income tax. Yes or no, sir? Right? And in that list of chapters, if you remember, the first priority we have given to the total income problems, right? Because in income tax paper now, when you open the income tax paper, the very first question you observe is the problems on total income. It's a compulsory question. And after that, you have some guaranteed question chapters like PGBP, profits or gains from business or profession, capital gains. Especially out of the total 5 heads of income, we have what are they, Amma? Income from salaries, income from house property, PGBP, capital gains, income from other sources. Out of these 5 heads of incomes, PGBP and capital gains heads are the compulsory question chapters. 95% of the cases, in every attempt, you will get a question from PGBP for 8 marks. You will get a question from capital gains for 8 marks. Apart from that, the provisions from PGBP and capital gains will also be asked as a part of the problems on total income. Are you following, sir? Right? So now let's come to the running notes. Every one of you start in a fresh page, put the main heading. Chapter number 4. Capital gains. Sections covered, section 45 to 55, capital A. Sections covered, section 45 to 55, capital A. Okay, ma. So the weightage of the chapter we can write here. Weightage of the chapter. One problem compulsorily we can expect for 8 marks. Right, sir? And next one, sir. List of important sections from this chapter. List of important sections. If you remember, sir, even under the head income from house property, first we have seen the list of important sections and then we have discussed about the remaining sections. Yes or no, sir? So the list of important sections, as usual, the very first section, what is that, Amma? Charging section. Section number 45. And then section number 47 discussed about exceptions to transfer. Exceptions to transfer. Another important question section. And then we can take section 50, that is computation of capital gains in the case of sale of depreciable capital assets. Depreciable capital assets. And then we can take section 50C, 50C, where the sale value is less than stamp duty value. Less than stamp duty value. In this scenario, we have to take full value of consideration. FVC, full value of consideration, is equal to stamp duty value. And then we have to take section 54, which deals with the concept of exemptions from capital gains, and then two important definition sections. Section 2 clause 14 discussed about the definition of capital asset, and then section 2 clause 47 discussed about definition of transfer. Okay, these are the list of important sections from this chapter. Section number 45, the very first section of the chapter, which deals with the charging section. Section 47, exceptions to the transfer. Section 50, computation of capital gains in the case of sale of depreciable capital assets. 50C, where the sale value is less than stamp duty value. In that scenario, we are going to take the full value of consideration is equal to stamp duty value. Then section 54, exemptions from capital gains. Section 2 clause 14, definition of capital asset. Section 2 clause 47, definition of transfer. Okay, ma? Right. Now, let us start with the very first section of this chapter, section 45. So every one of you, ma, put the heading. Section 45, subsection 1, charging section. Section 45, subsection 1. Because here section 45 is a series, amma. 45 section, we have a series like section 45.1, charging section, which is applicable for the general cases. And after that, we have some special cases for which we have special charging sections like section 45.1a, section 45.2, 45.3, 45.4, 45.5, and 45.5a. These are all applicable on some special circumstances. In the normal circumstances, section 45.1 is applicable. Do you remember, sir, while I'm discussing about the income from house property, I've already told you that while you are discussing the heads of income, first you have to discuss about the two sections, and then only you have to discuss about the remaining part of the sections. What the two sections first we have to discuss about? Number one, charging section, and number two, method of accounting applicable to that particular head of income. Method of accounting applicable to that particular head of income. Clear, sir? Because charging section deals with what are the different types of incomes taxable under this head of income, and method of accounting deals with on what basis that incomes are taxable. On what basis that incomes are taxable. So what are the incomes taxable? Explained by the charging section. On what basis they are going to be taxable? Explained by the method of accounting. Every one of you following now? Right, sir. Now let us try to understand the charging section of this particular chapter. Look at here, section 45.1, charging section. Any profits or gains arising from the transfer of a capital asset is chargeable under the head capital gains in the previous year in which the transfer takes place. Okay, ma. Unless such capital gains are exempted from tax under section 54 series. Clear. So let us try to note down the same in our running notes. So it goes like this. Any profits or gains arising, on transfer of a capital asset, any profits or gains arising on transfer of a capital asset is chargeable to tax, under the head capital gains, in the year in which transfer takes place. The year in which transfer takes place. So this is a charging section, sir. Right, sir? Can anyone repeat it once again, sir? Any profits or gains, arising on transfer of a capital asset is chargeable to tax under the head capital gains in the year in which the transfer takes place. So there are three important terminologies we are going to learn from this particular charging section. Three important terminologies. Number one, transfer. Number two, capital asset. And number three, in the year in which transfer takes place. Clear, sir? Right? So any profits or gains arising on transfer. Transfer of what? Transfer of capital asset. Transfer of what, Amma? Transfer of capital asset. So whenever you're transferring a capital asset, on such transfers, if you're getting any profit or if you're getting any gain, that gain is chargeable to tax under the head capital gains. But when in the year in which the transfer takes place. Clear, sir? Every one of you. So I've transferred a capital asset. I purchased a capital asset for 1 crore. I've transferred it for 1.2 crores. I have transferred it for 1.2 crores. So I got a gain of 20 lakhs. Now this 20 lakhs chargeable under the head capital gains. When it is going to be taxable, ma? In the year in which the transfer takes place. Are you following, sir? So the wordings in the year in which the transfer takes place, the wordings in the year in which the transfer takes place explains about this particular sentence, explains about the method of accounting applicable to this chapter. Method of accounting applicable to this chapter as per the provisions of section 145. Are you following, sir? Now let me explain you with the help of example. Look at the example, sir. Example number one. Suppose that Mr. X transferred a residential house property. On 31st January 2022. On 31st January 2022. Mr. X transferred a residential house property on 31st January 2022. Consideration agreed let us say some 50 lakhs rupees. Consideration agreed 50 lakhs rupees. Down payment received on 10th of March 2022. Rupees 10 lakhs. Remaining consideration received on 10th of April 2022. That is equal to 40 lakhs. Okay, ma. Right. Let us make some small modification. Down payment also you have received in the month of April. And the remaining installments you have received 10th of May. I'll tell you why I am making these modifications. So on 31st of January 2022, we have transferred a residential house property. Consideration agreed 50 lakhs and down payment received on 10th April 10 lakhs and remaining consideration received on 10th May 40 lakhs. Here you can see ma, the transfer taken place during the previous year from the above example. Transfer taken place during the previous year (2021-22), but consideration received during the previous year 2022-23. Yes or no? See, transferred on 31st of January 2022, and in which previous year it is falling, amma? In the previous year 21-22, and you have received the consideration on 10th April 2022 and 10th May 2022, and during the previous year 2022-23. So transfer taken place in the year 21-22, consideration received in the year 22-23. Now my question is, whatever the capital gains arising on transfer of this residential house property, for which previous year the capital gains are taxable? Are they taxable for 21-22 previous year, or are they taxable for 22-23 previous year? The answer is, look at the method of account. What method of accounting suggesting? Taxable in the year in which the transfer takes place. So as per the charging section, you can note down that year of chargeability is equal to year of transfer. Right, sir? So that means in the above example, capital gains are taxable. During the previous year 2021-22. But you will get a doubt here, sir. During the previous year 2021-22, I have just transferred my house property. That's it. I have not received any consideration. I have received the consideration almost 3 months after. I have transferred in the month of January, but I have received the consideration in the month of April and May. But still, irrespective of the fact whether you received the consideration or not, if the transfer taken place, the previous year in which the transfer taken place, the capital gains are taxable. That's it. End of the matter. So why the provisions are made like this? Because see, if you are selling the capital asset to an unknown person, unknown party, then you will ask for the consideration immediately. Yes or no? Hardly you will give you a time of 1 month or 2 months for the payment of consideration. But if you are selling the same capital asset to a known person, if you are selling the same capital asset to a very close relative, can you ask the consideration immediately within a 1 month or within a 2 months? No. There is a ship in between you and your relative. In the ship of the relationship. Right, sir? Now, because of the ship, what happens? Relationship will give you a much longer time for the payment of consideration. You will give you some 6 months time or sometimes even 1 year time. Ante, because of your relationship, you are receiving the consideration after 1 year. See, you are waiting because you have a relationship. Why the department wait for that relationship, Amma? See, if the consideration capital gains are taxable on receipt basis, now the department have to wait until you receive the consideration. Yes or no? If you receive the consideration after 10 years, and the department have to wait for 10 years, huh? You are having a relationship, that is why you are waiting, Amma. Department relationship and income tax department least bother about your relationships. Clear? So that is why it is said capital gains, the method of accounting applicable for capital gains. What is the method of accounting, Amma? Accrual basis of accounting. Accrual basis of accounting. If you remember, sir, in the first chapter itself, I have given a table in which I have given you the method of accounting applicable to all the 5 chapters. Let me take you there. This is our first chapter running notes, if you remember. This is our first chapter running notes. Guttundamma. Important consideration relating to income, maximum marginal rate, special tax rates. Okay. And here only we discussed about the method of accounting. Section 145. Right, sir? So you can see all the 5 heads of incomes and where you can observe capital gains. The method of accounting applicable, accrual basis of accounting. Are you following, sir? Every one of you. Right? So as per the principles of accrual basis of accounting, paid includes payables. So that is why even if you're not received the consideration fully or partially, irrespective of that fact, capital gains are always taxable on in the year in which the transfer taken place. Are you following, sir? Every one of you. Clear, sir? Even during the year of transfer, even if you received some partial payment, like in this example, instead of 10th April 2022, if I made it 10th April, 10th March 2022, instead of, sorry, ma. So initially I've given that the down payment you have received on 10th of April. Suppose that instead of 10th April 2022, if I given the information like 10th March 2022, that means during the previous year 21-22, the year in which the transfer taken place, you have received a consideration of 10 lakhs, a partial consideration. Now for the previous year 21-22, only 10 lakhs consideration taken into account for the calculation of capital gains? No. You have to take into account the entire 50 lakhs as your sales consideration for the calculation of capital gains. Not only the 10 lakhs. Every one of you following now? Right now. So here you can write the method of accounting applicable, the important point. As per the provisions of section 145. 145 deals with what, Amma? Method of accounting applicable. Method of accounting applicable to the chapter capital gains is accrual basis of accounting. Accrual basis of accounting. Right, sir. So that's the importance of the last sentence in the charging section. In the year in which transfer takes place, capital gains chargeable to tax, and at the head, capital gains in the year in which the transfer takes place. So irrespective of the fact of receipt of consideration, capital gains always taxable on in the year in which transfer taken place. Next, sir, for the purpose of levy of the capital gains tax, another important point, for the purpose of levy of capital gains tax, for the purpose of levy of capital gains tax, the following two conditions should be satisfied. The following two conditions must be satisfied. Now, what are the two conditions? The two conditions are, number one, there is a transfer. There is a transfer and transfer must be of capital asset. Transfer must be of a capital asset. Transfer must be of a capital asset. So these two conditions must be satisfied. There is a transfer, and number two, transfer must be of a capital asset. If the above two conditions are satisfied, then capital gains tax is leviable on such transfer. If any of the two conditions are not satisfied, then capital gains tax is not leviable. Clear? Now let us try to understand what are these two conditions. Okay, ma? Right. So for the purpose of understanding these two conditions, first one should understand the definition of capital asset, and after that the definition of transfer. Okay, ma? Because what are the two conditions? First one, there must be a transfer, and second one, transfer must be of a capital asset. So first we should try to understand the definition of capital asset and the definition of transfer. Then we can understand these two conditions. Okay, ma? So first, every one of you put the headings here. Definition of capital asset. Definition of capital asset. And the definition is given under section 2, clause 14. Section 2, clause 14. Okay, ma. Now let us try to understand the definition of capital asset. So look at here, sir. So first we have done with this point number one. Point number A, any profits or gains arising on transfer of a capital asset chargeable under that capital gains tax in the previous year in which transfer takes place. In the previous year in which transfer takes place, unless such capital gains are exempted. See, under what are the circumstances the capital gains are exempted? We are going to discuss under section number 54. Okay, ma. Next, in other words, year of chargeability is equal to year of transfer. I've already told you. This particular sentence explained about what, ma? Method of accounting applicable to this particular chapter. Method of accounting. Okay, sir. And then exceptions that section 45 series, we have 45 1A, 1B, 2, 5, 5A. These are all some exceptions to this method of accounting, and that exceptions we will see later. Okay, ma'am. See, even under the head income from house property, we have studied the same method of accounting. Even for income from house property also, the method of accounting applicable is the accrual base of accounting. But we have an exception for that. Can anyone tell me what is that exception? Municipal taxes paid. Municipal taxes are allowed as deduction only on payment basis. Even though method of accounting applicable to for that chapter accrual basis of accounting, but for municipal taxes the deduction is allowed only on actual payment. Okay, now similarly here also the method of accounting applicable accrual base of accounting. Capital gains are taxable in the year of transfer, but there are certain circumstances. These are some exceptional cases where the capital gains are taxable, on receipt basis. On receipt basis means the previous year in which the consideration received, only in that previous year the capital gains are taxable. Okay, now next, receipt of consideration and installments. Even in that case also the entire consideration has to be taken into account for computing the capital gains, irrespective of the fact whether you're receiving the consideration in lump sum at a time or whether you're receiving the consideration in installments over a period of time. Still, while you're calculating the capital gains, the entire consideration to be taken into account. See, when your capital gains are taxable for the year 21-22, while you're calculating capital gains, you have to take the full consideration into account, not part of the consideration, because you have received only part, irrespective. Are you following, sir? Next, now moving on to the definition of capital asset defined in section 2, clause 14. Now we can see the definition of capital asset divided into two parts: includes and excludes. Now first let us look into the inclusions. Capital asset, capital asset includes, capital asset excludes, Okay, ma'am. Now first let us look into the inclusions portion. First one, inclusions law. First one, property of any kind. Property of any kind means whether it is a movable property, whether it is a movable property or immovable property or tangible property or intangible property. Intangible property. So property of any kind, whatever might be the nature of the property, movable properties, like movable properties like furnitures, gold, jewelry, shares, right? All these comes under movable properties category. And immovable properties, land, building, or anything which are permanently attached to the land and building comes under the category of immovable properties. Then tangible properties means the properties which we can see and which we can feel, which we can touch. All there comes into the tangible property category. Right, sir? You have a gold chain. It is a tangible property because you can see, you can touch, you can feel. Are you following, sir? I have a mobile phone. I have a mobile phone with me, which you can see, which you can feel, which you can touch. Are you following, sir? My laptop, which I'm using for my classes, my webcam, right? All these are tangible. Land, building, car, anything which you can see, which you can touch, which you can feel is a tangible property. Intangible properties, which you cannot see, which you cannot feel, which you cannot touch, like goodwill, patents, trademarks, copyrights, designs, drawings, logos, franchisee. All these are comes under intangible properties category. So any kind of property, whether it's a movable property, immovable property, tangible property, intangible property, comes under the definition of capital asset. That's the first point. Second point, you can see here. Second point, you can see here. Securities held by the FIIs, foreign institutional investors. Foreign institutional investors, FIIs. Securities held by the FIIs. Even if the securities are held as a stock in trade. The important point here, you have to note it down. Important point. Even if such securities are held as stock in trade. Right, sir? So any kind of securities held by the foreign institutional investors, FIIs, it's a capital asset. It is a capital asset. And whether they are holding the securities as an investment, whether they are holding such security as a stock in trade, irrespective, it will be capital asset in the hands of the foreign institutional investors. Clear? And number 3, latest amendment by the Finance Act 2021. Third one is the latest amendment, sir. Amendment by Finance Act 2021. Right. So third one recently added, sir. You can see here third one. So first one I've already explained. Point number A and B I've already explained. It includes property of any kind, whether movable, immovable, tangible or intangible, connected to business or not, whether that asset is connected to your business or not, irrelevant, amma, right? And any securities held by the FIIs which has invested in such securities accordance with the SEBI regulations, right? Next, third one, which is a latest amendment. In my material, all the latest amendments were given in italics, which you can easily identify. If any text is given in italics, that's an amendment. You can see the change in the font style between these 2 points and this point. Change in the font style. It is in the normal style, and now it is in the italic style. Every one of you following now? Right? Now, what is this point about? Any unit linked insurance policy, ULIPs, unit linked insurance policies issued on or after 1st February 2021, to which exemption under section 1010D does not apply. Does not apply. Now, what is 1010D exemption? 1010D exemption explains about exemption with respect to lump sum amount received on maturity of policy, right, sir? So whenever your policy got matured, right, you are going to receive a lump sum amount, right? And that lump sum amount is exempted from tax as per the provisions of section 1010D, right? But there are certain circumstances where the exemptions under section 1010D not applicable, right, sir? And that means whatever the lump sum amount you're receiving from that policy, fully taxable. Clear? Now here, the first condition is that the asset nature must be a ULIP, unit linked insurance policy, and that must be issued on or after 1st Feb 2021. Second condition. Third condition, to which exemption is not applicable. So first it must be a ULIP. Second condition, it must have been issued on or after 1st February 2021. Third condition, for which exemption benefit not applicable. Why? Because the premium payable was exceeding 2,50,000 for any of the previous year during the term of such policy. Right, sir? So that means, let me explain you with the help of the notes. Third one, Indama, it must be a unit linked insurance plan, ULIP. And the second condition, it must be a unit linked insurance plan. Second condition, issued on or after 1st February 2021, and to which exemption benefit under section 1010D not available. 1010D not available. Okay, ma'am. So the asset must be a unit linked insurance policy, and that must have been issued on or after 1st February 2021. And the exemption benefit under section 1010D should not be available to such asset. And why we are not giving exemption benefits, sir? Because of the following reasons. What are the reasons? Number one, the premium payable exceeding 2,50,000 rupees for any of the previous years during the term of such policy. That means, let us take an example. Let's take an example, sir. Let us take an example. Suppose that Mr. X invested in ULIPs invested in a unit linked insurance policy on 10th of March 2022. So the policy was issued on or after 1st February 2021. This condition satisfied, this condition satisfied. It's a ULIP and issued on or after 1st Feb 2021. Both the conditions are satisfied. My unit linked insurance policies means what? How it is differed from a normal insurance policy? Under normal insurance policy, whatever the premium you are paying, that premium is towards only risk element. That premium is only towards a risk element. But when it comes to the unit linked insurance policies, whatever the premium you are paying, the premium represents the risk element, and as well as certain portion of your premium represents your investment. Like suppose that you are paying a premium of annual premium of, suppose that you are paying an annual premium of 30,000 rupees. Out of this, towards investment, some 10,000 rupees, towards risk coverage, 20,000 rupees. 20,000 rupees. See, generally we will take the insurance policies for the coverage of the risk element. Whatever the premiums we are paying, 100% of the premium adjusted towards risk coverage. But when it comes to the unit linked insurance policies, certain portion is towards a risk coverage and the certain portion is for the investment. Now this 10,000 rupees per annum investment, the insurance company will make investments on behalf of you into the various mutual funds, and the mutual funds will allot the units to the insurance company, and the insurance company will maintain the units on behalf of you. That is why these insurance policies are called as unit linked insurance policies. You are not only making the risk coverage here, you're also making investments into the units of various mutual funds. Unit linked insurance policies. This 10,000 will be invested by the insurance company in different mutual funds. Are you following, sir? Now the third condition is that the exemption benefit under section 10 clause 10D should not be allowed because the annual premium paid exceeding 2,50,000. In case if the annual premium paid by you, if this annual premium paid by you is greater than 2,50,000, then 1010D benefit is not available to you. The exemption under section 1010D not available to you. You have to make sure that the annual premium should be less than or equal to 2,50,000 during the term of the policy. Let us assume that the term of the policy is 10 years. In any of the 10 years, if the annual premium exceeding 2,50,000, suppose that from year 1 to year 9, you have made annual premiums of some 50,000 per annum, sir. But in the year 10, the last year of the term of the policy, you have made an annual premium of 2,60,000 per annum. So the first 9 years, you have satisfied the condition. The annual premiums are less than 2,50,000. But in the last year, the annual premium exceeded 2,50,000 rupees. So the SSE is not eligible to get the benefit of section 1010D. That's the first point. Second point, the aggregate amount of the annual premiums paid. Aggregate amount of annual premiums paid exceeding 2,50,000. Exceeding 2,50,000. In this scenario also, exemption benefit under section 10 clause 10D not available. Not available. Aggregate amount of annual premiums paid. See, the first example I've explained now, that is with respect to a single ULIP. If you have made investments only into the single ULIP, all this discussion up to here, you have made investments only into single unit linked insurance policy. Suppose that you are made investments into more than one unit linked insurance policy. You have made investments into more than one unit linked insurance policy. Suppose that you made investments into 5 unit linked insurance policies. Example, you have taken 5 unit linked insurance policies. And the annual premiums is as follows. Like on ULIP 1, the annual premium sum 50,000. ULIP 2, annual premium sum 80,000. ULIP 3, annual premium 70,000. ULIP 4, annual premium sum 30,000. And ULIP 5, annual premium sum 40,000. So now you have to make the aggregate amount of all these annual premiums. How much you are getting, sir? 13, 20, 23, 27, 2,70,000. Aggregate amount of annual premiums. Aggregate amount of annual premiums. 2,70,000 rupees, which is greater than 2,50,000. Now in this scenario also, section 10 clause 10D exemption benefit not available. So that means third condition also satisfied. What is the third condition, Amma? Exemption under section 1010D not available. If all these three conditions are satisfied now, such ULIP you have to be considered as a capital asset. If all these three conditions are satisfied, whatever the ULIP we are discussing about, it is a capital asset. That unit linked insurance policy should be treated as a capital asset. If any one of these conditions are not satisfied now, then that should not be treated as a capital asset. Suppose that the annual premium paid by you is less than 2,50,000. Then you are eligible for section 1010D exemption benefit. Whatever the lump sum amount you are receiving on maturity of the policy, it is fully exempted from tax. So there is no need of treating your ULIP as a capital asset. In that scenario, there is no need of treating your ULIP as a capital asset. The ULIP should be treated as a capital asset only when these conditions are satisfied. Every one of you following now? Right? So that's the inclusions part, Amma. Capital asset includes. So far we have discussed inclusions part. Okay now. So there are 3 points we have discussed. Number 1, property of any kind. Movable, immovable, tangible or intangible. Whether connected to your business or not, it is a capital asset. Number 2, any securities held by the FIIs, foreign institutional investors. And number 3, unit linked insurance policies. Clear? Inclusions. Now time for the exclusions. Capital asset excludes. Everyone put the heading, sir. Capital asset excludes. Capital asset excludes. First one, capital asset excludes personal effects or stock in trade. Okay, stock in trade. Personal effects excludes stock in trade. Stock in trade is not a capital asset, sir. It's your inventory. It's your inventory. It's not a capital asset. See, whatever the profits you are getting by transferring the stock in trade, you will getting the profits, and that profits are taxable under the capital gains. Are you following, sir? See, if you have any inventory in your business, right? If you are trading that inventory as stock in trade, any gain or profit transferring on this stock in trade, profit or gain resulting on transfer of this particular stock in trade, this will be taxable under the head PGBP, sir. But when such inventory treated as a capital asset, any gains arising on transfer of such capital asset, taxable under the head capital gains. So first of all, you have to determine the nature, how you are treating that stock in trade, as an inventory, as a stock in trade, or as a capital asset. How you are treating your inventory. So this will be treated purely depends upon the nature of business you're doing. The nature of business you're doing. Are you following, sir? Suppose, let us take an example that Mr. X sold as jewelry. For him, jewelry is a capital asset. Jewelry is a capital asset. Are you following, sir? If the same jewelry is sold by some Tanishq jewelers, Kalyan jewelers, right? See, if Kalyan jewelers sold jewelry, Kalyan jewelers sold the jewelry, sir. Now, in that case, for them, jewelry is a stock in trade, because buying and selling of jewelry is a business activity of Kalyan jewelers, is a business activity of Tanishq jewelers, is a business activity of Joy Lucas, Joe Lucas. Are you following, sir? Right? For Mr. X, for a common person like us, see, if I sold a jewelry, for me, jewelry is a capital asset, sir. If I get any gains and transfer of such jewelry, right, the capital gains comes into the picture. I need to pay the capital gains tax. But when it comes to a Kalyan jeweler, a Joy Lucas, Joe Lucas, Tanishq, for them, buying and selling of the jewelry is a business activity. For them, jewelry is a stock in trade. So in order to treat a particular item asset as a stock in trade or as a capital asset, it's purely depends upon the nature of the business you are doing. The nature of the business you are doing. Similarly, let us take one more example. Mr. Y purchased 10,000 shares for long-term purposes. Now for Mr. Y, this 10,000 shares should be treated as a capital asset. Because he purchased the shares, but for the purposes of a long-term purposes, he's going to held that shares for a long-term purposes. For him, this is an investment, Amma. This is an investment, and it is his capital asset. Now, let us take another example. Mr. Z also purchased 10,000 shares for intraday trading. For intraday trading purposes. Here you can observe the nature, sir. Now, whatever the 10,000 shares purchased by Mr. Z should be treated as a stock in trade. Are you following, sir? Why? I'll tell you, ma'am. Here, Mr. Y purchased the shares with an intention to hold them for a long-term purposes. Here, Mr. Y nature should be treated as an investor. But Z purchased the shares for intraday trading. Within the same day, he's going to sell them. Mr. Z nature is a trader. See, his business activity is buying and selling of the shares. Like Rakesh Junjunwala. His business activity is daily buying and selling of the shares, intraday tradings. He's purchasing the shares, but not for the main purposes of holding them for a longer period, but only for the main purposes of selling them on the same day or on the next day. See, he purchased for 100 rupees, and even if the share price increases to 105, immediately he will sell, because he purchased the shares in a bulk quantities, right? Some 10 lakh shares he purchased at 100 rupees. Within 1 hour, it is increased to 105 rupees. So on each share, he is getting a profit of 5 rupees. Like that on 10 lakh shares. So 10 lakh shares into 5 rupees. So within 1 hour, he got a profit of 50 lakhs. That's it. Are you following, sir? So for him, the shares are stock in trade. So when it comes to the shares and securities, debentures, bonds, you have to see the nature, the purpose, whether you are an investor or whether you are a trader. If you are an investor, for you, the shares, stocks, securities, debentures, bonds, all these are to be treated as a capital asset. If you are a trader, trader means buying and selling of that securities, buying and selling of that shares, buying and selling of the debentures is a business activity. For them, they're all to be treated as a stock in trade. Stock in trade. Every one of you following now? Right, sir? Okay. Now, look at here, exclusions. Capital asset excludes stock in trade other than the securities held by the FII. I already mentioned you. Foreign institutional investor, even if they are holding the securities as a stock in trade, still they are to be treated as a capital asset to them. Okay, now stock in trade explanation chundama. Meanings for the above purposes. Stock in trade means raw material or consumable stores used by the assessee in his business or profession. It is the nature of the business of the assessee that will decide whether an asset is held as stock in trade or not. Okay, now, so whether that asset is a stock in trade or not, it's purely depends upon what? Your nature of business. Look at the examples. In case of an assessee who deals in vehicles that were held by him for trading purposes shall be treated as stock in trade. Hence, it is not a capital asset. Who deals in vehicles, and the buying and selling of vehicles is his business activity. Like Varun Motors, Kun Hyundai Limited, Geetesh Bajaj, Adi Honda. These are all the dealers in vehicles, and buying and selling of motor cars, buying and selling of two-wheelers is their business activity. They're buying cars for trading purposes. So for them, it is a stock in trade. So not a capital asset. Next, if an assessee uses vehicle for carrying out its trading activities, then such vehicle shall be treated as used for business purposes. Hence, it is a capital asset. Sir, I purchased a truck for the purpose of transportation of the goods. Now, this truck is a capital asset to me. Is a capital asset to me. So I purchased the truck, but not for the purpose of resale. For the purpose of transportation of the goods from one place to another place. I'm using this truck in my business. So it is a capital asset to me. Clear? Every one of you. It's not a stock in trade to me. So the first one in term of capital asset excludes stock in trade. Completed. Now the second one, capital asset excludes personal effects. Second one, what, sir? Personal effect excludes. Capital asset excludes personal effects. So what do you mean by personal effects? Look at here. Personal effect means movable property. So clearly mention movable property, and only movable properties are comes under personal effects. Then what about immovable properties? Immovable properties are out and out capital assets. See, whenever you find an immovable property, it's a capital asset. But again, it's purely depends upon your nature of the business. See, I purchased a building. For me, it is a capital asset. If the same building is purchased by a real estate person, for him, it is a stock in trade. Because for a real estate person, buying and selling of the buildings is his business activity. Everyone's here, right? So movable properties, including wearing apparels, furniture, held for personal use by the assessee or any member of his family member, depends on him. To be treated as a personal effect, the following two conditions must be satisfied. The asset must be movable in nature and it must be held for personal use, either by assessee or by his family members. Either by his assessee or by his family members who are depending upon assessee. Then it should be treated as a personal effect. Every one of you following now? Right, sir. Now let me tell you some examples for personal effects. So capital asset excludes. Second one in term. First one we have discussed stock and trade. Second one we are going to discuss capital asset excludes personal effects. Personal effects. Okay, ma'am. And in order to treat a particular asset as a personal effect, it must be movable in nature. Movable in nature, and it must be used by the assessee or any of his family members for personal purposes. For personal purposes. Then only it should be treated as a personal effect. Okay, ma. Now, let me see some examples. Sir, I purchased a laptop. Mr. S purchased a laptop for 50,000 and the same laptop sold for some 60,000. You can see I got a capital gain of, I should not say as a capital gain, I got a gain of rupees 10,000. I purchased for 50,000, sold it for 60,000. I got a gain of 10,000. Now the question arises whether this 10,000 taxable under the head capital gains. First of all, you have to see for what purposes you have utilized your laptop. Sir, I've used my laptop for my personal purposes. For my personal purposes. So then it is not a capital asset. And these gains are not taxable under the head capital gains. These gains are not taxable under the head capital gains. Not taxable under the head capital gains. Every one of you following now? Right, because laptop is a movable asset. Laptop is a movable asset and you have used it for your personal purposes. Not a capital asset, not taxable under the head capital gains. Every one of you. Number two. Sir, I purchased a mobile phone for my personal purposes. I purchased it for some 30,000, sold it for 35,000. I got a gain of 5,000 rupees. Now, will it be taxable? No, again, because mobile phone is a personal effect. I purchased a car for my personal purposes. Purchased for 10 lakhs, sold it for 12 lakhs. I got a gain of 2 lakhs. Will it be taxable? No, again. Car is a movable asset and used for personal purposes. Next, I'll give you one more example. Mr. A purchased jewelry for rupees 10 lakhs. Used for personal purposes. Used for personal purposes. Okay, ma'am. And later, he sold the same jewelry for 15 lakhs. Now, he got a gain of rupees 5 lakhs. Now, my question is whether this gain of rupees 5 lakhs taxable under the head capital gains. Whether this gain of rupees 5 lakhs taxable under the head capital gains. Answer is no, not taxable. Not taxable under the head capital gains. Not taxable under the head capital gains. Why, sir? You will get it out. Why, sir? Why? Because you may ask me like, sir, jewelry is a movable asset. Is a movable asset, and you have clearly said that it is used for personal purposes. Both the conditions are satisfied, no? So why not jewelry is a capital asset? Sorry, why not jewelry is a personal effect? Sir, it is a personal effect, hence not taxable under their capital gains. It is a personal effect, hence not taxable under their capital gains. But whatever the conclusion you have given, see, your explanation correct. Jewelry is a movable asset used for personal purposes. This explanation correct, but the conclusion is not correct. Conclusion is not correct. It is taxable under the head capital gains. This gain of rupees 5 lakhs taxable under the head capital gains. I think this said it is a personal effect. No, it is a personal effect because it is movable in nature and used for personal purposes. It's a personal effect. Answer is no. It's an exception to personal effect. This is an exception to personal effect. Personal effects have some exceptions, ma'am. Even though it is a movable asset, even though it is used for personal purposes, still not to be treated as a personal effect. Sir, we have learned so far that capital asset excludes personal effects. Capital asset excludes personal effects. And now, just now I've told you that personal effects excludes jewelry. Personal effects excludes jewelry. So that means capital asset includes jewelry. Capital asset includes jewelry. Sir, capital asset excludes personal effects. Personal effects excludes jewelry. So capital asset includes jewelry. So jewelry forming part of your capital assets. So you might have learned a formula in your mathematics. Minus into minus is equal to plus. So excludes into excludes is equal to includes. So capital asset excludes personal effects. Personal effect excludes jewelry. So means capital asset includes jewelry. So though jewelry is a movable asset and used for personal purposes, still it should be treated as a capital asset. It should be treated as a capital asset. So any gain arising on transfer of jewelry is chargeable to tax under the head capital gains. Okay, ma. I think in the initial stock in trade example, yes, Mr. X sold a jewelry, capital asset. I mentioned it as a capital asset. Do you remember, sir? Just now, for the explanation of stock in trade, I've taken the jewelry example only. I have mentioned it as a capital asset. Clear, sir? Next. So now look at in the textbook, sir. You have seen the personal effect definition, right? And the conditions, but personal effect excludes, you can see, personal effect excludes jewelry, even held for personal purposes. Archaeological collections, drawings, paintings, sculptures, any work of art, all these are comes under capital assets now, because personal effect excludes, these are all the assets. No, now these are all forming part of capital assets. So jewelry is your capital asset. Paintings, drawings, archaeological collections, sculptures, all these are now covered under the definition of capital assets, and any gain on transfer of all these assets chargeable to tax under the head capital gains. Okay, ma'am. Next. An immovable property and aforesaid assets held for personal use are not personal effects and hence are capital assets. Immovable property out and out is a capital asset, because here in order to treat an asset as a personal effect, it must be movable in nature. So that's why immovable properties are not personal effects, means they are capital assets. Okay, now example, a house property, even though used for personal purpose, cannot be treated as a personal effect and shall fall within the definition of capital assets. Next, securities are not personal effects. Why, sir? Securities are movable in nature and I'm using securities for my personal purposes. How are you going to treat securities for your personal purposes, ma? See, if I purchase a phone, yes, I'm using the phone for my personal purposes. Yes, I'm using. I purchased a laptop, I'm using for my personal purposes. I'm taking classes, I'm doing my office works. But when you purchase the shares, can you use your shares? The only thing you can do is you can buy shares, you can sell shares. That's it. But you cannot use shares for your personal purposes. Can you do any work on the shares? Share is an intangible asset, amma. Yes or no? When you purchase the shares now, the shares will be credited to your demat account. Earlier, we used to have the physical share certificates. Nowadays, all the share certificates are dematerialized. All of the share certificates are now in dematerialized form. They are directly credited to your demat account. So can you use the shares for your personal purposes? They are intangible. How can you are going to use? So that's why securities, even though the nature is movable, you cannot use them for your personal purposes. Hence, they are not personal effects. So that's why securities are out and out capital assets. Okay, ma. So we are in the definition of capital asset. The capital asset definition is consisting of two parts, inclusions and exclusions. So far, we have completed inclusions part, and even the exclusions also we have completed first 2 points. Stock in trade, personal effect. Okay, ma. Now I am winding up the session here. In my next session, I'll continue with the rural agricultural land. I'll continue the capital asset definition, point number 3. Exclusions point number 3. Okay now. So till then, have a good day and good night. Stay home and stay safe, sir. Okay.